Irene and Kenneth have the same $85,000 in annual retirement income. Both receive $32,000 from Social Security, $28,000 from a municipal pension, and $25,000 from portfolios. One of them paid $11,400 in federal taxes last year. The other paid $4,820. They have the same income, but they do not have the same tax bill. The difference is not legal tricks or aggressive loopholes. The difference is the order in which they withdrew money from their different accounts. It is whether they planned the withdrawal sequence before the year began rather than after it ended. One of them understood that taxes in retirement are a game of sequence. The other just spent what they needed and let the IRS take what it wanted. The answer depends on a number most people never look at. It is not how much they earn, but which account the money comes from and in what order. Chapter 1. You think your tax rate in retirement will be lower than your rate during your working years. Sometimes that is true, but often it is not. Your tax rate in retirement depends on three things that most retirees do not coordinate. It depends on the source of your income because different sources are taxed differently. It depends on the timing of when you access that income because timing determines your tax bracket. It depends on whether you have done any planning before the tax year begins. The people who pay $11,400 on $85,000 are paying taxes they could have avoided. The people who pay $4,820 planned before January 1st. It is that simple, and it is that rare. Here is how retirement income is taxed at the federal level. Most retirees have four potential income sources. Social Security benefits are taxed on a sliding scale called the provisional income system. If your provisional income is below $32,000 for a single filer or $44,000 for a couple, your benefits are not taxed. Above those thresholds, up to 85% of your Social Security becomes taxable. The taxable percentage increases as your provisional income increases. At the highest levels, 85% of every dollar is taxed as ordinary income. Traditional IRA and 401k withdrawals are taxed as ordinary income at your marginal rate. Taxable brokerage accounts generate capital gains and qualified dividends. These are taxed at preferential rates of 0%, 15%, or 20%. Municipal bond interest is federally tax-exempt. Roth distributions are tax-free. The problem is most retirees have no plan for managing their income sources. They take Social Security, their pension, and withdrawals from their traditional IRA. They let the taxable account sit and compound, assuming it is safe. At tax time, they are surprised their Social Security is partially taxable. Their IRA withdrawal pushed them into a higher bracket, costing more than expected. The tax code is not a mystery. It is a set of rules. The rules are knowable, but they require looking at the whole picture. You have to look before the year starts, not after it ends. The IRS publishes the thresholds and brackets every year for everyone to see. They are public information, but the question is whether you actually read them. Chapter 2. Let us take apart Irene and Kenneth's tax situations in the same year. The difference between their tax bills is not small, and it is not accidental. Irene's financial advisor planned her withdrawals before the year began. She has an IRA with $400,000 and a brokerage account. Her Social Security is $32,000, and her pension is fixed at $28,000. Her advisor structured her $25,000 withdrawal from her taxable account. That account generated long-term capital gains and qualified dividends. After the standard deduction, her total taxable income was $41,200. She is in the 12% bracket, paying $4,820. Kenneth has the same account structure and the same income needs. His advisor did not do tax loss harvesting or any bracket management. Kenneth took his $25,000 withdrawal from his traditional IRA. His total taxable income hit $61,200. That put him in the 22% bracket, costing $11,400. The difference between their tax bills is $6,580. Over 25 years, that is over $164,000 in taxes. They have the same quality of life, but they do not have the same retirement. The difference is $548 per month. That is a car payment, a month of groceries, or a prescription copay. The difference is real, and it is entirely avoidable. The reason for the $6,580 difference is not complicated. Irene's advisor understood that every dollar from a traditional IRA is taxed as ordinary income. Every dollar from a taxable account is taxed at capital gains rates. And in the 12% bracket, those are zero. The IRS created a bracket where capital gains are zero for single filers below $47,025 and married filers below $94,050 in 2025. Irene's advisor parked her right inside that bracket for capital gains purposes. Kenneth's advisor did not do this, or Kenneth did not have an advisor who did this, or Kenneth just did not know to ask. The information is not secret. It is entirely public. The willingness to actually use it is rare. Chapter 3. There is a technique that Irene's advisor used that is so powerful and so underutilized by ordinary retirees. It deserves its own chapter. It is called tax loss harvesting, and it is one of the most valuable tools available to retirees. Tax loss harvesting is the practice of deliberately selling investments that have lost money in a taxable account. The purpose is generating a tax loss that offsets capital gains elsewhere in your portfolio. It is not about selling investments you believe will underperform. It is about selling investments that have already underperformed in a way that creates a tax benefit. The IRS allows you to use capital losses to offset capital gains. If your losses exceed your gains, you can deduct up to $3,000 per year against ordinary income. The remainder carries forward indefinitely. There is no expiration date on a capital loss carry forward. If you accumulate $50,000 in losses, you can use them at $3,000 per year. That lasts for the rest of your life, plus all capital gains, indefinitely. That is not a small number. At a 22% marginal rate, $3,000 per year in deductions is worth $660. Over 30 years, that is $19,800 in tax savings. It is a strategy that required doing nothing but noticing when your positions were down. Here is how it works in practice. Kenneth's taxable account had a position in a tech sector ETF that lost $14,000 in 2023. His advisor did nothing. Irene's advisor sold the position, realized the $14,000 loss, and immediately purchased a similar but not identical ETF to maintain market exposure. The $14,000 loss was used to offset $14,000 in capital gains elsewhere in Irene's portfolio, eliminating $2,100 in capital gains taxes at the 15% rate. The ETF sale and repurchase happened within 30 days, so the wash sale rule did not apply. The wash sale rule disallows wash sales when you buy substantially identical securities within 30 days before or after a sale at a loss. But a similar ETF is not substantially identical. Irene's advisor knew this, but Kenneth's advisor did not. The difference in that single transaction was $2,100 in taxes saved. Over 5 years of systematic tax loss harvesting, Irene's advisor saved approximately $11,400 in taxes that Kenneth's advisor left on the table. Chapter 4. The most overlooked tax planning tool available to retirees in 2024 and 2025 is the qualified charitable distribution. And it is free for anyone who is 70 and a half or older with a traditional IRA. A qualified charitable distribution, or QCD, allows you to transfer up to $105,000 per year directly from your traditional IRA to a qualified charity. The transfer counts toward your required minimum distribution for the year. It is excluded from your taxable income, and it counts against your RMD requirement without being counted as taxable income. For a retiree in the 24% bracket with an RMD of $30,000, directing $20,000 of that RMD to a charity via QCD costs the retiree $20,000 in cash, but reduces their taxable income by $20,000. The actual out-of-pocket cost of the $20,000 charitable gift after the tax savings is approximately $15,200 for a retiree in the 24% bracket. The charity receives the full $20,000, and the retiree saves $4,800 in taxes. The IRS forgoes the tax revenue. This is the IRS saying, in effect, we will forgo this tax revenue if you give it away instead. Most retirees never take advantage of this provision because they do not know it exists. It has been available since 2014 and expanded in the Secure 2.0 Act. The knowledge gap is enormous. The Federal Reserve's 2024 survey found the median retirement balance for ages 65 to 74 was $202,000. For these households, a $20,000 QCD is not a small number. But even a $5,000 or $10,000 QCD can meaningfully reduce taxable income, especially when RMDs push a retiree into a bracket they did not expect to be in. The QCD is one of the few tax code provisions that benefits both donor and charity. It does this without the IRS extracting a tax cost. It is also one of the few provisions that benefits the retiree more than the charity. The tax savings are real and immediate, while the charitable benefit is distributed over time. Irene used QCDs, giving $20,000 per year to her church and alma mater. Her church received the money, and her taxable income was reduced by $20,000. Her IRA tier for the following year was lower, and her Medicare premiums were lower. The QCD created a cascade of benefits that extended well beyond the immediate tax deduction. Chapter 5. Irene's tax plan for 2025 involves 6 decisions made before January 1st. First, she will take her Social Security at the optimal time to maximize the benefit amount. Second, she will take her RMD from her traditional IRA at the minimum required amount. Third, she will withdraw $25,000 from her taxable account for annual expenses. She will harvest losses when available and manage capital gains, timing carefully. Fourth, she will execute a $20,000 QCD to satisfy part of her RMD requirement. This keeps that money from being added to her taxable income. Fifth, she will review her IRA tier in October, not January, to avoid any nasty surprises. Sixth, she will coordinate with her tax advisor in October to review the projected tax picture. She does this to make any final adjustments before the year closes out. Kenneth does not have a plan, he has intentions. He intends to be careful with money and talk to an accountant. He intends to look into charitable giving and do a QCD if it makes sense. He intends to manage his capital gains and do these things. They are on his list, and they have been there for 3 years. He will do them eventually, but the IRS does not have a category for eventually. The IRS has a category for this year, and Kenneth will pay $6,580 more in taxes than Irene. Next year, another $6,580. The year after, another, and the year after that, another. By the time Kenneth gets to eventually, he will have paid $165,000 more in taxes than Irene. That is not a rounding error, that is a car. That is a kitchen renovation or 2 years of healthcare premiums. That is money that could have been his. Chapter 6. There is a planning horizon that most retirees cross without realizing it. It creates a tax planning opportunity that is frequently missed. It is the Roth conversion window between retirement and the first required minimum distribution. Kenneth retired at 65, but his distributions begin at 73. That is an 8-year window where his income is lower than it will ever be again. This is the ideal window for Roth conversions. Kenneth could convert $50,000 per year from his traditional IRA to a Roth IRA. He would pay taxes at an effective rate of 18 to 22%. This eliminates a future liability that would have been taxed at 24 to 32%. The taxes would come from his taxable account, which has $180,000 not needed for expenses. The math is straightforward, but the execution is rare. Most retirees do not convert because they do not know the window exists. They do not have an advisor who tells them about it. They feel that paying taxes now is the same as paying more taxes later. It is not the same. The difference between a conversion at 22% and a future tax at 28% is a 6% permanent savings. On $400,000, that is $24,000 saved. On $400,000 compounded over 20 years, That is $65,000 in future obligations eliminated. Irene converted $50,000 per year for 6 years, from age 65 to 71. She paid $55,800 in conversion taxes. Her future RMDs are based on a $210,000 traditional IRA balance instead of $420,000. Her annual RMD at age 73 will be $7,925 instead of $19,623. The difference in her annual RMD is $11,698 per year. Over 20 years, that is $233,960 in taxable distributions she will never receive. Those dollars are in her Roth, compounding tax-free, growing to approximately $630,000 by age 93. Irene paid $55,800 in taxes to create $630,000 in tax-free wealth. Kenneth paid approximately $40,000 per year in taxes on his RMDs for 10 years and will pay approximately $185,000 over 25 years. The difference is not the tax rate. The difference is the plan. The number most people never calculate is this. The average retiree pays approximately $51,000 in federal income taxes over a 20-year retirement, according to IRS data. A retiree with a tax-efficient withdrawal strategy pays approximately $22,000 over the same period. The difference is $29,000, which invested at 5% over 20 years, grows to approximately $77,000. Tax efficiency is not a tax question. It is an investment return question. Every percentage point of tax savings is a percentage point of investment return. Irene understands this, but Kenneth will eventually. The question is, how much eventually costs him before he gets there? The number is $165,000, and it is already gone.